In this video, we're going to discuss current stock market conditions in the United States as of May 2022 and why one should be greedy when others are fearful. We will also discuss the concept of an off-election buying opportunity, which seems reasonably likely to occur during 2022. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently working as a retirement strategist and portfolio analyst, as well as an adjunct professor of accounting and financial management. So far in 2022, we have had reasonably sized stock market drops. The S&P 500, as of the making of this graph, is down around 16%. It's been down a maximum of 19%. The NASDAQ has been down far more at 26%, and extremely speculative investments like ARK investment is down over 50%. Other indices like the Dow are down around 12, and some international indices such as the Vanguard European, the Vanguard Asian, and the Vanguard Emerging Market Index are also down in the range of 10 to 15%. In historical bear markets, this is not anything particularly remarkable. 19% doesn't compare with the dot-com bubble, where you had a drop of close to 50%, or even the COVID scare from last spring of 30%. And certainly not with the housing bubble, where you had a drop of 56%. In length of market drops, we are just over 5 months now. That's longer than 3 of our bear markets shown on our list here, but certainly shorter than the housing bubble, the early '80 recession, which took 21 months to resolve, or the dot-com bubble, which took 31 months to resolve. As discussed in one of my previous videos, one of the best predictors of how stocks behave during a bear market is the Wilshire growth to value ratio. And we can see here that the growth to value ratio at the beginning of this close to bear market was 1.38, which was the second highest after the dot-com bubble. So our bursting now has behaved as predicted, a lot like the dot-com bubble, and value stocks have drastically outperformed growth stocks. If you would like to know more about that and a detailed study of all these previous bear markets, you can refer to one of my previous videos on my YouTube channel, Are Value Stocks a Safe Haven During Bear Markets, which was published in September of 2021. And just look under Kirby Cundiff on YouTube, or particularly this link here for that video. At this point in time, there are multiple different measurements of valuation in the market. A straight price to earnings ratio doesn't look too bad. It's dropped pretty drastically during the 19% drop so far. If we compare it to the dot-com bubble, it is most of the way down to the bottom. It's still above historical mean evaluations, but not extremely so, and it's really about in historical mean evaluations for the post-Bretton Woods default in the 70s. So during the era of central bank activities, we're close to the mean range. So by that measurement, the stock market is reasonably valued. By other measurements, like the longer-term Shiller P/E ratio, the U.S. stock market is still well overvalued and about median of where it was during the 2000 dot-com bubble, and still above the peak before the drop in 1929. By the so-called Buffett index, which looks at the total value of all publicly traded stocks versus the U.S. GDP, the U.S. stock market is also still highly valued, above most historical evaluations, except the top that we just had a few months ago. It's also worth noting that the U.S. stock market has had a long-term run that has outpaced the rest of the world, probably making the U.S. stock market still expensive by world standards, and as we will discuss later, this may be an indication that other places might be better to invest than the United States. So what has happened so far, pretty much what was predicted in the value investing video. We can see here the split up of value stocks and growth stocks. We've had a drop in the small cap value fund, which had a major run up in the last few years of around 12%, and large cap values down around 8%, with mid cap value down 9%. And these have obviously performed much, much better than the growth funds, with most of these down in the 24 to 25% range, ranging from the small cap value to large cap value. So as sort of predicted, basically this has been a tech bubble, or at least a half tech bubble. If you look at what happened during the dot-com bubble, reasonably similar outcomes. During the dot-com bubble, at least by the end of that time period, both small and mid cap value are actually up. Large cap value was down 23%, but the growth stocks were completely crushed, down from mid cap growth performing the best at negative 60% to large cap growth at the worst at negative 62%. So our bursting of, I guess, this bubble has not been nearly as bad as the dot-com bubble, but at the same time, the growth value ratios weren't as extreme as during the dot-com bubble. But the split up has been the same. Value has drastically outperformed growth. And you can see here, if we look at the growth to value premium, we didn't start at nearly a bad a position for growth as during the dot-com bubble, and we've gone down over half of it. So it seems likely that this premium will continue to go on down, and that in the near future, value will continue to outperform growth, but a lot of this growth premium has now been burned out of the market. Right now, the U.S. markets are experiencing extreme fear, and this is generally considered a contrary indicator. The argument would be if everybody is scared to death, they have already sold their stocks, or they have bought put options on their stocks, and to some extent they have got out of the market. At some point in the future, they are going to change their mind and enter the market. So extreme fear is commonly correlated with market bottoms, and when that fear changes, the market tends to recover. Whereas if you are in a condition of extreme greed, everybody already has their money in the market, as we saw last year, and then at one point in time, as is occurring or has occurred now, they change their mind and pull their money out of the market, which causes things to drop. So you want to buy when there are blood in the streets. You want to buy when everybody else is afraid, which at least over the short term is probably now. If we look at changes in the fear and greed index, they occur pretty frequently, so this is a good predictor for maybe a couple of months. So right now we are extreme fear. We were up far more in the greedy range just at the beginning of April, and in the extreme greed range near the end of last year. So it seems likely over the next few months that you will get somewhat of a market recovery. Other measurements that commonly go into the fear gauge would be things like the equity put call ratio. This would be the number of people buying puts, those that are worried about the market dropping, versus the number of people buying calls, those that think the market is going to go up. If people are worried about the market dropping, they buy puts. If those puts expire into the money, then that will in fact by itself cause a stock market rally, since you then would have to buy the underlying stocks at a higher price than the current stock market. So we're about 0.8. This is not nearly as extreme as during March of 2020 during the COVID scare, but it is consistent with market bottoms, or at least short-term market bottoms, at previous time periods going back for the last 5 years. So it seems pretty likely, unless we get a extreme case like March of 2020, that we are approaching a market bottom. Of course, something like this, which would involve another 20% drop, is possible, but we're pretty consistent with market bottoms over the last 5 years. The CBOE Volatility Index is also an indication of market timing. This is a measurement of how much people are willing to pay for portfolio insurance, like for put options. And you can see that again, there are more extreme time periods. Certainly March of 2020 are during the bottoming following the housing bubble, but with the exception of those two, we have gone up significantly on the volatility index, and it's reasonably consistent with market bottoming time periods, even back here during the bottoming of the dot-com bubble. So again, we are probably close to a market bottom. No guarantee of that. You could have something more extreme, but certainly it's a far better time to buy now than it has been for the last year. Another reason to be bullish in 2022 is the concept of the presidential election cycle theory. Usually stock markets do well in the third year after a presidential election, and they tend to do relatively badly in the second year, and this is where the concept of the off-election year buying opportunity has come from. We're going to go through that in detail, and that seems likely to occur in 2022. So in 2016, Charles Schwab analyzed market data going back to 1950. It showed that generally you have positive markets. They do tend to go down 1 out of 3 years, but the average is positive, and the strongest year is pretty much always the third year after a presidential election. And during year 3 after a presidential election, the S&P saw an annual increase 88% of the time. So it only went down 12% of the time. This is a pretty strong correlation. The other ones aren't nearly that good. Market gained only 50% of the time and 64% of the time during years 1 and 2 of the presidency. So pretty highly likely that 2023 will be a good year. There's a good chance that the market will bottom sometime in 2022 and at least rally by the end of 2023. We will now explore why a presidential election cycle of the stock market exists and why you tend to have off-election year stock market buying opportunities. This is related to both the fiscal policy and monetary policy of the federal government and the Federal Reserve System. The Federal Reserve, of course, prefers to fight inflation in non-presidential election years, and the incumbent political party will spend money to try and get reelected. In 2020, when Trump was running for re-election, we saw stimulus checks and massive money printing, which resulted in a bull market after the drop in February of March. This tends to be done by both political parties. Currently in 2022, we have monetary tightening, dropping of the stock market, overseas wars, and shortages of baby food. These are not the conditions in which an incumbent president or an incumbent president's political party would like to run for re-election. You can see here the extraordinary money printing measured by the M2 money supply that occurred in 2020 after the stock market drop related to COVID. This resulted in what money printing tends to result in, massive inflation. Here you see inflation rates in 2022 that we have not seen in the United States since the 1970s and the Volcker fighting inflation era. The bottom red line, the Consumer Price Index, as officially measured currently by the federal government, is around the 8% range. If, as Shadow Stats does, you calculate inflation the way they believe it was done by the federal government pre-1980s, we in fact have a much higher inflation rate of around 17%. We're now going to look at evidence for the last 60 years of the concept of the off-election year buying opportunity and the following run-up. we will find for the first 40 years, from the early 60s till around the bursting of the dot-com bubble, this concept worked very well. Unfortunately, during the last 20 years, it hasn't worked as well, probably due to the fact that the Federal Reserve had much higher interest rates to deal with before the more recent zero interest rate policy. So here in 1962, we have a pullback consistent with the idea of an off-election year buying opportunity, followed by a run-up, particularly in 63, and then the election of Lyndon Baines Johnson over Barry Goldwater in 1964 in a very positive stock market environment. We then end up with a pullback in the off-election year of 1966, followed by a good run-up with a little bit of a variation here, peaking right after the election of Richard Nixon in 1968, beating out Hubert Humphrey. We then had a pullback with an off-year election buying opportunity in 1970, followed by a very large run-up, which peaked right after the re-election of Richard Nixon against George McGovern in 1972. We then had a pullback and an off-year election buying opportunity in 1974, followed by a run-up to 76, and the effort of Gerald Ford, which failed to defeat Jimmy Carter, who was elected in 76. Again, we have a pullback in 78, and a run-up to the effort of Jimmy Carter to get reelected, which failed against Ronald Reagan in 1980. It's interesting that even though Jimmy Carter had appointed Paul Volcker to the Fed, who had raised interest rates significantly to fight inflation, that the stock market continued to go up, but this did not help Jimmy Carter, and he lost the election anyway. We have a pullback after this in the 1982 recession and an off-election year buying opportunity in 1982. After the 82 off-election year buying opportunity, we again have a run-up to the 84 election. Now after this, things don't work quite as well. You really don't have a very good buying opportunity in 86, and perhaps that results in this continued huge run-up into 1987, which was burst with the drop of 20% in one day and the Black Monday crash of 1987. So this particular election cycle does not work. And then you have the 1988 election of George Bush over Michael Dukakis. Our cycle after this does start to repeat again. We have a good off-election year buying opportunity in 1990, a run-up to the 1992 presidential election where Bill Clinton defeated George Bush, and then proceeding on to 1994, we do get a pullback, but that takes a little while to stabilize. So there's multiple pullbacks in 94, multiple, if you like, off-election year buying opportunities, and then a nice run-up to the 1996 election where Bill Clinton defeated Bob Dole. Our cycle continues, and we have an off-election year buying opportunity in 1998, followed by a huge run-up of now the dot-com bubble, which peaked right before the 2000 election, and then you start to get a bit of a pullback right before the 2000 election where George W. Bush defeats Al Gore. This pullback continues with the bursting of the dot-com bubble, and classically it ends in 2002 with an off-election year buying opportunity which is retested in the beginning of 2003 at the beginning of the Gulf War. Now things break down a bit, and for the next 20 years, our concept of an off-election year buying opportunity does not work as well, probably due to the Federal Reserve's zero interest rate policy. So after the re-election of George Bush over John Kerry, we really do not get a particularly good off-election year buying opportunity in 2006. We largely get a continuous run-up until the peak of the housing bubble, and then that bursts and keeps going down in 2009, regardless of the election of Barack Obama in 2008. We do get what could be looked at as an off-election year buying opportunity in 2010. We get a run-up with a gap in here into the 2012 election, which works reasonably well. But then again, there's not really any good buying opportunity before the 2016 election. We do get a repeat with a buying opportunity in 2018, and then a run-up approaching the 2020 election, which is disrupted by COVID in March of 2020, but then with the massive interaction of the Federal Reserve System, we get an even larger run-up after that. But then that is bursts, and we come down here to our near 20% drop where we are today. So is this an off-election year buying opportunity or not? The best guess is probably that it is, but of course we could have a deeper drop now as we did consistent with COVID. Telling the future is never an easy thing. One can also attempt to analyze how you end up with presidential election cycles from movements in the Fed funds rate. This doesn't always work, but at some time periods it works particularly well, primarily in the 70s when the Fed is fighting inflation, but only between presidential elections. It certainly does not seem to correspond as perfectly as the actual movements in election cycles, which work pretty well. Of course, there are two components in governments attempting to stimulate the economy to get reelected. Both fiscal policy and monetary policy come into effect. In general, the Fed is reluctant to raise interest rates during presidential election years. One person that didn't seem to play much in the way of politics was Paul Volcker. He was very happy to raise interest rates up into Jimmy Carter's election, which may have contributed to Carter not being reelected. But of course, you've still had a stock market rally during most of 1980 when Jimmy Carter lost to Ronald Reagan, and Volcker didn't seem to pay a whole lot of attention to politics throughout his tenure in office. Right now, there's a lot of concern about the Federal Reserve raising interest rates to fight inflation. There is one very good reason to think they're not going to be particularly aggressive about that, and that is the national debt. When Paul Volcker was fighting inflation in the 1970s and raised the Fed funds rate up to close to 20%, the national debt was way less than it is now. And the federal government currently is, of course, having problems paying interest on its debt at 2 or 3%. If it was 20%, this would make things far, far more difficult. And it took 10 years of the 70s for the government to really take inflation seriously. My guess is it will take at least that long today. If we look again at the Fed funds rate cycle, during the Paul Volcker era, we were up here around 20%. Inflation may in fact be as high now as it was then. And of course, if the Federal Reserve raised interest rates this high, the housing market would crash, the stock market would crash, everything would get repriced. It seems highly unlikely they will do that at any time in the near future. A far more likely scenario is during this interest rate raising cycle over the next year or so, they might raise rates back to where they were before the 2020 COVID crash, which is a Fed funds rate of only around 2.5%. Closing recommendations. Right now, there is tons of fear in the market. You do not want to sell when everyone is afraid. You want to be greedy. So right now is not a good time to lower your fear in the stock market. At minimum, wait a few months. Most likely consistent with presidential election cycle theory, this year is not going to be a good year to sell, but a good year to buy. It is likely that the market will bottom sometime in 2022. Perhaps it's bottoming now. Perhaps it will rally from this point and retest its lows. Perhaps there will be a deeper low as in 2020 during March. Either way, it is likely 2023 will be a good year. I would stay risk on until at least the fall of 2023 and probably up until past the election in 2024 and to at least spring of 2025. For multiple years after the bursting of the dot-com bubble, growth stocks drastically underperformed value stocks. I think that is likely to continue. I would avoid all growth stocks, whether large, medium, small, and certainly things like ARK. They are perhaps going to get some counter trend rallies, but the large probability is that value stocks will outperform in the next few years, just like they have so far this year and did in the several years after the bursting of the dot-com bubble. Good value stocks would be VTV for large cap, VOE for mid cap, VBR for small cap, and VYM for high dividends. The average international stock now is a value stock by U.S. terms, so investing in international stocks could also be a good idea. VGK is European stocks, VPL is Asian stocks, VWO is emerging markets, and VYMI is high dividend international stocks. Sources for the graphs and discussions that were made in this video come from Yahoo's finance site, the St. Louis Fed's site. Investopia has a discussion of presidential election cycle theory. Long-term Trends has tons of very useful graphs related to both the domestic and international markets. And Y-Charts also has a large number of useful graphs, which is where we got the graph on the CBOE put call ratio. I thank you for watching this video.